In accounting, we have different accounts that we need to master in order to understand and to have a better comprehension regarding the transactions or business transactions. As what we've discussed in the previous lesson, we had two kinds of transactions, the external and internal transactions. External transactions are the trading that's happening between the customers and the owners, or the employers and the clients, while internal business transactions pertains to the transaction within the organization or the company. Well, transactions to trading composes of different accounts. We have what we call the assets of the company, liabilities of the company, the equity of the company, the revenues or the income, and of course the expenses. In accounting 1, we are to determine the basic recording of business transactions. So without this accounts title or the mastery of the accounts, we won't be able to determine what happened, or maybe what comes in, what comes out in the business. So take a look at the asset column. Asset comprises of the cash, notes receivable, account receivable, interest receivable, merchandise inventory, office supplies, prepaid insurance. We also have like prepaid rent, land, store equipment, accumulated depreciation, store equipment, office equipment, accumulated depreciation, office equipment. Actually, this group of assets might be or maybe will be able to be adjusted depending on the company. Some they have also furnitures, store supplies, and they also have like buildings. Depends on the kind of company or maybe type of business that they will be having. Of course, if the owner have their own building, at the start they have to purchase, so that will considered as the asset. If they have furnitures and equipment also, then that will be part of the asset, because this is asset is something that the company owned. So for the mastery of the assets, which is something that the company owned, at first at the beginning the company might be having or maybe needing a cash or an investment. So once they put up money on the business, it has an effect on the assets, wherein that gives an increase in the asset. Remember, increasing the assets once there is an investment at the first day or first date of the transactions or beginning of the company. And also, as the effect in the assets, whenever the company receive a money for every transactions, that gives an increase in the cash, which is under asset. On the other hand, whenever the company purchase, let's say supplies, furnitures, equipment on the other company or other stores, once you purchase something, for example, like shampoo, of course you'll be needing to use the money. Therefore, there's a thought that money comes out of the company. So there will be a decreasing effect or negative effect when it comes to the cash. Note receivable. When you say receivable, this is the expected or claim of the owner of the business from the client. And when you say notes receivable, there is a promissory note or a signed paper wherein the client have an agreement that he or she will be able to pay the liability on your part as the owner. So, for example, you sold the merchandise, you sold the computer, but the client doesn't have enough money at the time, so he said, or they signed a contract saying that they will pay it at the end of the month. So once they're signing a contract with you, and that will give you a due date when they will pay, that is a notes receivable. But without signing a note, that turns out account receivable. Remember, receivable pertains to you as the owner, that you have the right to claim money on the part of the clients. Same thing as interest receivable. This is mostly experienced by banks, wherein they are giving interest. For example, you bought a car, and of course it's by loan, and every month you have to pay an interest of 1%, 2%, 6% of the interest of the car. And for example, the bank gives you that 6% or 5% for the um, car, or maybe a house that you loan, and suddenly you won't be able to pay it. Of course, they're expecting some money, and that turns out the interest receivable on the part of the owner. Once they claim it, that what turns to cash. Merchandise inventory is your stocks as a seller, or maybe a stock as a supplier also. But then before starting your own car shop, of course you'll be needing to create or give some stocks or have some stocks itself. In Sari Sari store, of course, you need to have or to buy some chips or candies, all of the stocks. So since you bought this merchandise or the inventories or the stocks, that pertains or that comes in on the company, that is the asset. And of course, once you sold it, then there will be a decreasing on your inventory. Again, note receivable, the effect will be increasing if you are about to claim something. For like for example, there is a agreement for today that the client signed a note that they will be able to pay you by the next end of the month. So what will happen would be there's an increase in note receivable because you are expecting something. On the other hand, account receivable, if there's no written paper but you're still expecting something or money in return, then that's an increase in account receivable. For example, today is one, and then at the end of the month, they paid you already. Once they paid you as the owner and you claim the money already from this other client, then there will be a decreasing effect or negative effect on account receivable and notes receivable. Same thing in interest receivable. Once you're still expecting or not yet claimed amount of money, that's an increase in receivable. But once you claimed it, then we turn it to zero, meaning negative effect in receivable. In merchandise, once you bought stocks for this month, then it comes into the business, meaning there's an increasing or positive effect on merchandise inventory. Then once you sold or used those inventories, there will be a decreasing or negative effect on inventory. In office supplies, these are like ball pen, notebook, paper, pins, bond paper that will be used in the office or maybe for selling also. So for example, you bought an office supplies because you want your workmates or your workers or maybe your sisters as personal supplies to use it. So once you bought the supplies, of course, you can use money. If you bought the supplies and you use money, if you bought the supplies, which is an asset, this comes in on your business. So therefore, it gives you an increasing effect on your asset. While the office supplies is increasing because you have to use it and you need it in the company, maybe the accountant will ask you, what did you use in order to buy supplies? Of course, you use cash. So if you use the cash, there will be a decreasing effect on your asset because you use the money and able to get a supply. And then this will have a negative effect or decreasing effect once you use money, which is an asset, to buy another asset, which is supplies, that gives you an increasing effect. Next, we have the prepaid insurance. Prepaid insurance, these are the advance payment. We call it sometimes prepaid expense, but this is under assets. This is the advance payment for the rent, for insurance, for some interest, and you you didn't or you're not yet even use it or consume it, but you are acquiring it and paying it in advance. And of course, that will comes a negative effect on the cash if you use the money of the bank. But of course, the reason will be you pay the prepaid insurance. So for example, these two are considered as the assets. So there will be an effect of prepaid insurance positive or increasing because this game or this is the reason why you have a deduction or decreasing effect on your cash. What is the reason why you lost some money? This is because you use it for paying the advance payment on insurance, or maybe this is not insurance, maybe this is a rent. This to code is prepaid expenses but under assets. Same thing as office supplies, the company will be able to buy land. If they're going to buy land, and that will give them positive impact on the land. And if they will be going to use money, then there will be a decreasing or negative impact into cash. Remember, in double entry bookkeeping, there should be 2 to 3 effects in one transaction. For example, we have positive, positive land, meaning they bought land, and if they're going to use the money, then there will be decreasing in the money. For example, store equipment that will be used in the company, everything must be used in the company. Then store equipment positive, that means that they need equipment in the company, and maybe they will be using cash, that gives a different decreasing or negative impact on the cash. Accumulated depreciation store equipment. This is used if they'll be going to sell store equipment after 5 years or 10 years. So they only have limit of 1 year. 1 year to more than, let's say, 3 years, they will be able to sell their equipment. So accumulated depreciation pertains to the depreciating value of an item if they will be going to use or to sell it in the near future. Office equipment, because we have for managers, and of course like own computers, own printers, same thing as for equipment. And of course, this is non current assets or fixed assets which will stay in the company more than 1 year. Office equipment and store equipment. So once they plan to sell it in the near future, then they will be having an account title of accumulated depreciation of office equipment and store equipment. And that's the assets. You can have like furniture. So remember the effect. Whenever there is an effect in the cash, let's say decreasing, because you're going to use cash in any item to buy or purchase, then there will be a decreasing effect. But once you sold land, store equipment, or let's say furnitures, once you sold it, then there will be an increasing effect in the cash. You have to remember the dual effect. There should be increase in one item and decrease in one item, or both will have an increase or both will have a decrease. And of course, this the effect of increase and decrease won't only be particularly for asset. It can also go beyond the account items. So let's say you have the liabilities. You have accounts payable, salaries payable, unearned rent, notes payable, rent payable, salaries payable, taxes payable, wages payable, utilities payable, rent payable. So all of the thing that the company owe from the other parties. Let's say the company have a land, but they borrowed the money to other parties like bank. So they will be having accounts payable or maybe notes payable if they have the written paper. For example, salaries payable. They still didn't pay the wages of the employees, so they will have salaries payable. Let's say the billing or the electric bill of the company. After 1 month, they didn't pay it. So they, for example, they have 2,000 of bills. Then there will be an increasing when it comes to payable, which is utilities payable. But once they paid it, then there will be utilities expense. We have two categories. Under liability account, we have utilities payable. Once the bills are not yet paid. But once, for example, at the 15th of the month, the owner will pay the bills. Then there comes the expense account. And the term would be utilities expense, because we already have the reason why there is a deduction when it comes to the cash. Ba't ka nawala ng pera? And because you have your utilities expense. That before you have a payable. So whenever you have a liability, maybe you didn't pay into cash and you borrowed money from the other person or other bank, this will give an increased effect on liability. And whenever you have expenses or other cause or reason why you don't have the money, or let's say you have to pay the rent, then that has the increasing effect on your expenses. That gives a reason why you have a deduction on the cash. For equity account, for corporation, we have stockholders' equity. And we have the capital stock as our puhunan or capital. But in merchandising or maybe the small type of business or sole proprietorship, we have what we call not capital stock, but we have owner's equity. For corporation, we have capital stock. Sole proprietorship, we have owner's equity. For partnership, we have, let's say, the surname of Juan de la Cruz, then the capital. That is the first partner. The second partner may be, let's say, Lim Capital. So both of them are handling one business, but the capital or equity code is divided into two, or let's say separated investment in recording of transactions. So whenever you have an equity, of course, you have your cash. There will be an increase in cash and increase in your capital because you're about to start your business. So for example, you invested cash in the business. So of course you have positive cash and positive capital. For example, you bought land, use cash. So you have positive land and negative cash. Let's say you bought equipment on account, meaning you didn't pay it in cash. So you have positive equipment and positive payable because you have the liability or obligation to pay later on within the month. But if you bought equipment using cash, then there will be positive equipment and negative cash. So let's say you have sold, binenta, sold equipment in other company and you receive right away money. So it means that negative store equipment because you sold it, but then you have an increase or positive cash because you receive a money right away. But for example, you bought an sorry not bought, you sold an equipment, but the client says that they will pay you the next day. So meaning you are about to claim or receive some money the next day. So you have sold equipment, which gives you negative store equipment, and of course they said on account. You sold the equipment on account. So negative store equipment and positive account receivable because you are to claim an item or cash in the next few days. We have revenue. Revenue is the income, what source of income you're having at the moment. For example, if it's merchandising, then you have sales. That is the term that you have to use for every transactions involving trading. Let's say store equipment and cash. Once you have sold an equipment, there is an increase in the cash, and that is pertains to the sales of merchandise or cost of sales. In servicing company, you have service revenue or service income, and of course there will be a cost of service, not a cost of sales. Expenses, that's what I'm saying, just like the utilities expense, but these are the reasons why you have negative effect on the cash, because sometimes the company are paying office salaries expense, let's say rent expense, and you have miscellaneous expense. So a lot of expenditures of the company aside from the assets. Assets are something that the company owned. Expenses are the company's outflow. Okay, so outflow meaning the company is releasing some money, have expenditures to pay, a lot of things to pay, but of course for the production of the item, or let's say for the productivity of the company. And we have revenues as the inflow. Ito naman yung pumapasok sa company. And you have other income, rent income and interest income. Depending, for example, interest income, you added an interest after the span of the period that they didn't pay for the interest. And also you have the interest expense as the partner. So remember, for example, the company paid advertising of the company. So let's say nagbayad ka ng advertisement. So you have an increase in the advertising expense and decrease in the cash. The effect of the expenses would always be positive or increasing because these are the reasons why you have a deduction on the cash. And the assets that might be increasing or decreasing depending on the transactions that they're giving. Liability is always increasing once you have an obligation to pay, but this will be decreasing or negative once you already paid your account. So let's have an example. Okay, example. First, the owner bought supplies on account. So this determined that once you bought a supplies, there's something that comes in the company. So you have supplies. Supplies is an asset, and you said that comes in the company, meaning the effect would be increase in asset, which is supplies. Next, there's an increase in the asset, but it they didn't use cash. They said on account. This pertains that you owe the supplies from other parties. So once you owe it without signing a note, or let's say no written paper, then that gives you a liability. The title would be account payable. And once you have a liability, then there is increasing. Account payable is a liability. So since we said that we owe something from other company, may utang tayo, so that's increase in liability, which is accounts payable. This is what you call the dual effect of double entry bookkeeping. The owner paid the supplies bought yesterday. This is what we bought yesterday. Now, they have to pay what they bought. So, since we have an accounts payable increasing in the first one, then they said the next day they have to pay. Kapag ka na binayaran mo utang mo, of course, that will be zero. So, we have accounts payable, which is decreasing. At first, it's increasing because you have liability, but once you paid, you have decreasing. That is decreasing in liability. Next, once you paid your liability, you have to use your cash. Cash is an asset, and once you use your cash, which is an asset, that will give you decreasing in asset, which is cash. So that is the dual effect still. The owner sold equipment on account. Once you sold an item, and that gives you a deduction on the item. So you have equipment decreasing, decrease in asset. And once you sold an item, they will ask you whether on account, if it should be paid today or the next day. So since it says that on account, meaning they will pay it the next days. So you have an expectation or something to be claimed the next day. And that is account receivable. Because there's still no cash involvement, but you're expecting something in the next few days. So that is account receivable. But if they said by signing a note, then that is not receivable. But because there's no signing of contract, then there is account receivable. And of course, that is an increase in your receivable or an asset. But once you receive the money, let's say the client paid you the next day, so the owner received payment on equipment from the client. So at first you have account receivable. Account receivable, since this is increasing as you're expecting something, Now you don't have to expect anything because you're going to pay. But of course, once they paid the equipment on your part, then you will receive some money. That's why it's increasing. And once you receive a money, that is increasing. Once they paid their liability, that is a decrease on your receivable. Next, the owner paid rent for the month in cash. So rental space. And what is the cause why you have a deduction in the cash? What is the reason why you don't have cash? Because you paid or you have an expenditure, that is rent expense. And whenever you have a cause of action why you don't have the cash, that gives you positive or increasing impact on rent expense or other expenses, maybe utilities, advertising, etc. For example, the owner paid advertising in cash. So they use cash in the payment of advertising. So once they use cash, that is decreasing. And what is the cost why it's decreasing? Of course, they have to pay the advertisement. So what is the cause of deduction in the cash? That gives positive on the expenses part. So I just want you to remember something, that is, for every assets, drawing, and expenses. Whenever you bought an item, whenever you have some expenditures, whenever the owner withdraws some money for personal use, that is increasing. And of course, whenever they sold the item, whenever they deducted some money on the drawing, and let's say there's no expenses, that is negative. Liabilities, capital, and revenue or income. Whenever the owner have a liability, investment, and inflow of cash, let's say there's profit or income, that gives you an increasing effect. And whenever the company pay the liability, so that will give you deduction. Whenever you use the capital for something, deduction. Whenever you use the revenue for something, deduction. This is the thing that you have to remember in analyzation of business transaction, increase and decrease.